Very good, warm welcome to everybody. Again, as I mentioned just now, I'm not entirely sure how Dr. Lance is gonna cram this into a session for us with what's going on in the world and locally, rising inflation rates, interest rates, Putin, etc., etc. It's a I don't envy your task, sir. That's all I can say. But everyone knows Dr. Lance, the rocket scientist, our Chief Investment Officer. We're privileged twice a year to have him talk to us and give us his insights and explain how we've positioned our portfolios based on current events and what we believe to be future events. Obviously, there's no crystal ball, but we do our level best. And with Dr. Lance's assistance, we managed to have got it right very successfully in the last couple of years. So I will be sending out the presentation once it's compiled. So if any of you, and please, you're very welcome to share with any of your colleagues or anyone that would be interested. We welcome that. But with that, over to Lance. I will turn my video off and mute myself for bandwidth reasons. But yeah, I'm very, very excited to hear what you have to say, Lance. Thank you.
Good morning, ladies and gentlemen. Thank you, Andrew. I'm not going to call it an opportunity this time. I'll call it a challenge in terms of putting the presentation together. As you can see, the title is a little longer than usual. It's not short and punchy. But as Andrew mentioned, there's a lot that's going on in the world. There's a lot that has been going on in the last 2 years. And we have always been aware in investment markets of what's called the known and the unknown. But I've decided to add that to the seen and the unseen because the seen and the unseen have actually been quite instrumental in terms of disrupting markets. And I call these the catalysts for global market disruption. These catalysts, I'm essentially going to focus on 4. One will be the coronavirus that is still with us. One is going to be Jay Powell, the chairman of the US Federal Reserve. The other one is going to be the autocratic Chinese regime. And the final one will be the warmonger Vladimir Putin. And what we're going to see, looking at seen and unseen and known and unknown, we're going to look at what these 4 catalysts have influenced in markets over the last 2 years. And I specifically use the title, the word disruption, because in many cases, these catalysts have caused market disturbances. They've actually been disruptions because it doesn't seem to have been permanent. But there are a couple of cases where the effect is probably going to be a lot more permanent than some people will like. This is a slide you will have seen quite often. But let's start with the unseen. And in fact, we can start with the unseen being the coronavirus. And we're just going to go back to Monday. If you've been watching the news, you'll see that on Monday, China instituted a very, very extensive lockdown in the city of Shanghai, also in Shenzhen. And they're going to be conducting mass testing. They have a growing outbreak of the virus. And the big concern about this latest lockdown is already economically, the nation has suffered hugely under their zero COVID strategy. This time around, residents will be required to stay home again. Deliveries will be left at checkpoints to ensure there's no contact with the outside world. Offices and all businesses not considered essential will be closed and public transport suspended. This has huge echoes with what happened 2 years ago. The thing about China is an autocratic regime, to put it mildly. If the Chinese authorities want to lock a city down or lock the country down, they will do it pretty much overnight. It will take a couple of hours. In the Western world, the so-called democracy, it's very, very different. In our own country, there will be a meeting of the National Coronavirus Command Council. Then there will be a meeting of mayors and provincial leaders. Then there will be a meeting with traditional leaders. Then there will be a meeting with parliamentarians. Then there will be a presentation in Parliament. And on a Sunday night at 8 o'clock, a good couple of days later, our president will address us in one of his family talks. The most important thing to remember with a country such as China is when they lock down or when they instigate some form of regulatory reform, it's very, very quick. It's very autocratic. There's no democratic process. And so as one came into Monday, the biggest Chinese cities went into lockdown. And of course, one can mention Hong Kong at the same time. Hong Kong has also got a huge problem with the virus. Their morgues are full. They're running out of coffins and their hospitals are full. So this unseen coronavirus has not left us yet. And what you're seeing in China right now is giving you shades of what we saw 2 years ago. And what is it that we saw 2 years ago? If we go back to the first quarter of 2020, we focus here on the S&P 500 equity index in the USA. It is, in our view, the bellwether equity index worldwide. And very often, when markets outside of the USA are a little unconcerned or somewhat rattled, they will take direction and influence from what happens in the USA. And as we remember, through hard experience, March last year, end of February, in 2020, was very, very disrupted. The market came off, the US market, some 34%. But what you have seen since then, or you did see since then, was a sustained recovery over a slightly longer period of time. But after a couple of months, the S&P 500 pretty much got back to where it was pre-lockdown. And so what we saw here was not any form of permanent damage. We saw you can call it a knee-jerk reaction, but it was a reaction because there was something that was unseen. We couldn't touch it or feel it or capture it or lock it away. The unseen led to a reaction because what it did lead to was an unknown environment of how these lockdowns were going to affect global economies. But after a good couple of months, it was quite clear that resilience in the economies was there. And even though the virus was not under control, that disruption had been eliminated. Markets could continue as they did beforehand. If you look at our own all-share index back home, we'd been going nowhere slowly for quite a long time, well into February 2020, and we suffered the same fate under lockdown as our authorities did the same, and we're down pretty much the same, about 35% bottom of the market, essentially a week ago, 2 years. We also formed part of that recovery, and over a good couple of months, we got to a point that where we had pretty much made up everything that had been given away during this lockdown period. And so what we saw initially with this unseen virus was a sharp negative reaction that turned out to be a disruption, and then things started to progress as far as equities are concerned in a little bit of a normal way. But let's extrapolate that. We go back and we look at the S&P 500 in the US and what I call the relentless recovery off the bottom of the market in March of 2020. By the time we came to the end of last year, that market had doubled, plus another 13% off the bottom in March of 2020. And I call this relentless because if you look at this chart of the S&P 500 index, yes, there's a few bumps here and there, but if you go from point to point, March 2020 to the end of last year, it was a very, very significant recovery. Even though in many cases, the impact of the virus was still being felt, development of vaccines was underway. But the US market turned out to be very, very resilient after the disruption that we saw in the first quarter of 2020. Interestingly enough, obviously, we as an economy were also affected by the virus. We also pretty much had a relentless recovery. Being an emerging market and not a bellwether global equity market, our ride was a little bit more bumpy. But at the end of the day, from the bottom of the market to where we closed at the end of December last year, our market, our all-share index itself was up 94%, and that actually excludes dividends. This is an index on its own. In particular, the last quarter of last year for the South African equity market was a very, very, very strong one. So it was also a disruption for us. But as we came to the end of 2021, we'd look back and our market has almost doubled as it had done in the USA. But if we look at the scene, what were we seeing in 2021? We were seeing a surge in consumer price inflation in the USA. And in fact, if one actually looks at the inflation chart from the bottom of the market just after the disruption in 2020, where US consumer price inflation had plummeted to almost zero, it closed the year last year at 7%. And this is a number that was last seen a number of decades ago in the USA. And the issue here, and we saw that right the way through 2021, was this debate amongst market participants and the US Federal Reserve about when and how quickly was the US Fed going to react with benchmark policy rates to try and put a lid on this inflation scourge. And so as we came towards the end of last year, equity markets had done particularly well, and inflation in the USA was surging. Inflation elsewhere was also on the rise, but nowhere near the extent to which inflation had surged in the USA. Now, if we go back to our investment committee meetings in November of last year, what we were also seeing was Chairman Powell often in virtual meetings and on Bloomberg TV talking about US inflation, increasingly becoming a lot more hawkish, expressing the need for rates to go up to fight inflation. There was a significant debate between market participants, some very influential, and the Fed as to whether inflation was going to be transient, that's what the Fed thought, or whether it was going to be sticky and resilient, as many market participants were feeling. And there was no consensus about this. The US Fed seemed to be taking a more relaxed approach. They felt that the economy was quite strong, but they felt that with inflation was going to be transient. But towards the end of last year, he started giving stronger messages that they were going to end their quantitative easing program sooner. And the market started pricing in more interest rates for 2022 this year and also next year. And so in the final quarter of last year, what was dominating the news wires and the investment landscape was what was the US Fed going to do about its benchmark policy rate, and when was this going to happen? And what we did early in December last year, I did mention in the introduction that in the invitation that we were going to talk a bit about some of the tools that we use to guide us in our investment decision making. One of them obviously is the Bloomberg terminal. You will see we make extensive use of graphs and charts in our macro outlooks. But what we also do is use some of the other elements of their process that give us some idea of what the market is expecting. And what this screen actually does is it actually tells us that the market early in December last year, when it looked at what was happening in the USA, was expecting a 55 basis point, 0.55% hike in US rates for 2022. The market then became very concerned that this was not enough. With inflation sitting at 7%, this was not going to be enough to go to deal with inflation. And on top of that, it did seem as though markets after that strong run in the US off the bottom in 2020 had become quite expensive or richly valued, as some of the commentators tend to call it. Again, what we know now, and it comes from our research partners, MRB, who provide us with extensive research on global investment strategy. And in October last year, they were already warning us that G7 government bonds were still very, very expensive. They were priced for a low growth environment, and they were priced for a low inflation environment. MRB's view was that the bond market was completely missing the bigger picture. The bigger picture was going to be significant rises in the benchmark interest rates and significant rises in yields across the curve, specifically in the US, but also seeping through into G7 economies. And what they said is stay maximum underweight within multi-asset portfolios, and that's what we did. We also believed that there was going to be a surge in US interest rates to fight inflation. And in fact, from the beginning of last year, we held no government G7 bonds in the offshore funds whatsoever. What was also important in October is they said that there's an air pocket underneath many of the global equity leaders. And we had, through our own research, been able to verify that markets were indeed pretty expensive. And you will have seen, some of you will have seen quite extensively in our talks, we mention a lot mechanistic guidelines that we produce through our computer models that give us some idea of how cheap or how expensive markets can actually be. But on the 12th of November last year, our market was saying that the US equity market through the S&P 500 was very expensive. And it was under that market that we believed MRB's air pocket was sitting. What our mechanistic model does, it involves no emotion whatsoever, purely based on valuations, gives us a weighting factor. If that factor is greater than 1, it means that the market in that geography is fairly cheap. If it's less than 1, it means that market is expensive. And it was warning us through 2 areas. The US, the S&P 500 was expensive by almost 20%, and that the Chinese market, the composite 300 in Shenzhen and Shanghai, was also expensive to the extent of 10%. And so we also felt through our own research that US equities and Chinese equities definitely had an air pocket sitting beneath them. But before we move into this year, let's go back to what China does, because this is an area that one needs to look at very, very carefully. And this is when the unknown, and that is how Chinese authorities will react, now becomes known. In November 2020, China was looking to curb the power of its domestic tech firms. It particularly went after Alibaba and Jack Ma personally. There was some very, very heavy selling that went on. Again, this happened overnight. There was no consultation. There was absolutely no warning that this was going to come, and then all of a sudden it was there. That's why I say the unknown, that's now the known, is China will crack down, and China will crack down very, very quickly when it sees the need. And in fact, in November, on one day alone, I think if memory serves, this was 11th of November, the top 5 Chinese heavyweights, the like of Alibaba and JD.com, $280 billion had been wiped off the market value of the top 5 tech heavyweights one day only. And here you start seeing something that is very different from the way the Western world reacts. China reacts very quickly, and the market response is immediate, and in this case, very, very negative. And that was only the start of what was going to continue in 2021 with Chinese regulatory crackdown. And in fact, in 2021, we became aware of what they call the Common Prosperity Plan. And in fact, in September, this was announced by President Xi. He wanted to address a yawning wealth gap that threatened the country's economic ascent and the legitimacy of Communist Party rule. Now, common prosperity was not a new idea in China, but the rhetoric was increased sharply, and it became a very, very clear message from the Chinese government that their market is policy driven. It's not, their economy is policy driven. It's not market driven. When they want to react, they'll react quickly, and they can react across the board. So the one unknown that is now known is if you're investing in China, you need to be very careful in terms of understanding Chinese Communist Party policy and the impact it could have on the particular shares that you have in your portfolio. And where this became most evident was in the USA. What we have here is a chart of the NASDAQ Golden Dragon China Index. This Golden Dragon Index is the only way, or the most convenient way, that foreign investors can access Chinese shares through the ADR, or the American Depository Receipt program. It was an extremely popular program. If you try and access Chinese shares directly in mainland China, there are only certain shares that are available. You've got to go through Hong Kong, and it's quite a process. But here you can access them directly. But from a peak in February of last year, this actually peaked after the Chinese authorities went after Jack Ma and Alibaba. Since February of last year, this index by the end of 2021 was down by 57%. Now, yes, this was a very richly valued index because it was easily accessible to foreign investors. But the combination of Chinese crackdown and the combination of rich valuations or air pockets has led this thing to be down some 57%. So the one thing that is now clearly known by global investors is be careful when you invest in China. You need to understand how the Chinese Communist Party reacts, and you need to understand how policy drives the economy and thus markets. So what was known as we came into 2022, sitting down in January in our investment committee meetings, what we'd seen is that the market was now expecting just over 100 basis points of hikes in the USA, up from the 55 that we saw early in December. So markets had woken up to the fact that the US Fed was quite serious, but our valuations had still suggested that the US market was expensive to the extent of some 15%. So coming into January, one was aware that the US market was expensive, and one was also aware that market was anticipating in the USA more frequent and more more extensive hikes in US benchmark interest rates. And then markets became rattled. Here is the US, the S&P 500 index, peaked very early December, also late December and early January. And by the time the 23rd of February arrived, that market was down 12%. That market was down because it was expensive at its peak and because it was worried about how much further the US was going to have to hike rates and how quickly they may have to hike rates. Same thing if you look at the NASDAQ. The NASDAQ, this is a tech-heavy index. in the USA. It doesn't like it. Tech stocks don't like inflation, and they don't like a high cost of capital, so they don't like to see interest rates go up. That was down some 18% off its peak in early January over there. And so by the 23rd of February, US markets had tumbled between 12 and 18%, worried about how the Fed was going to be reacting, but also off a very high valuation base. What we had done earlier on the 25th of January, what we'd actually decided to do is run our valuation models again. And what the valuation models had told us since the 13th of January to where the market had fallen by the 25th, that the US market was now approaching fair value. And that is something that we haven't seen for a number of years. In fact, we last saw that in 2019. And this for us was an important indicator to suggest that in the bellwether safe haven of the US S&P 500, it being close to fair value, in our view, suggested that maybe the market would not fall too far further, and that it would start seeing support at around those levels. Again, this is an unemotional set of guidelines. It's purely mechanistic, and it's based on third-party valuations. So late in January, our process was giving us signals that the US equity market, for the first time in just over 2 years, was returning to some semblance of fair value. And what that does is that suggests to us we should maintain our equity exposure, and that we shouldn't react in a knee-jerk reaction and reduce our exposure to equities and increase our exposure to cash. We are very, very valuation driven. Emotion makes very nice stories and presentations, but emotion is eliminated very much from our investment process. So late in January, we'd already decided that the market fall was probably close to its end, and that we would maintain fairly significant equity exposure going forward. What we also know, looking early in 2022, was the bond market in the US was rattled. This is the yield on the US 10-year Treasury bond, and it had moved up quite sharply. In fact, it had moved up the end of December from around about 1.5% to close to 2%. And had you held these kind of bonds in your portfolio, your capital loss would have been quite significant. But we had decided at the beginning of last year already that we wouldn't hold any US Treasury bonds. In fact, we wouldn't hold any government G7 government bonds. But this was also driven by the research that we got from Macro Research Board, suggesting that bond markets were complacent in the G7 economies. They didn't realize or didn't recognize the fact that the US Fed was going to have to react quickly with quite extensive rate hikes, and that was going to be negative for holders of bonds. So we managed to dodge that one, over at least the last 14 months. What is very interesting this time around, if you go back to the first quarter of 2020, we followed the US equity markets down. They were down 34%, we were down 35%, which is roughly the same. This time, it was different. If you look at the JSE All Share Index, we were actually, over the period of time that the S&P 500 was down 12% and the NASDAQ was down 18%, we were up 1.5%. Now, this seems a little unusual when there's global market disruption that we should be holding up. But as I'll show a little bit later, we were the beneficiaries of rising commodity prices, increased tax takes, trade balance that was looking very good. So there were economic factors that were in our favor. But what was also in our favor was, as fast as the US was going to raise interest rates, the market expected us to raise rates as well. So we weren't going to be at a disadvantage. But our market turned out to be a lot more resilient than what we saw in the USA. And that was all up to the 23rd of February. Then the 24th of February, the unknown becomes the scene. The unknown was everybody could see. You saw all the images of the Russian military buildup on the borders of the Ukraine. Ostensibly, these were going to be military exercises. And the unknown was, are these military exercises, or is this some form of buildup for an offensive against the Ukraine? While the hope was that these were exercises, it was dashed on the 24th when Vladimir Putin issued the order to his commanders to extend the military exercises into the Ukraine, as he calls it, but quite clearly it was an invasion. The big problem with this, other than it being war and a humanitarian crisis, it takes place in the European arena. When there's war in Vietnam or there's war in Afghanistan, it seems a little distant and far from the general crowd. When you have a war in what I call the European theater, then it becomes quite serious. And shortly after that, there was a very interesting interview with the Foreign Secretary from the UK. And essentially what Liz Truss was saying was she was bemoaning the fact that NATO took their eye off the ball because NATO was not expecting this invasion. And what's very, very interesting is if you look at what the EU is calling for right now, NATO members to be serious about defense spending. Oh, well, that's very interesting because when Donald Trump was in power, he took NATO to the cleaners because, number one, he said you guys were not committing 2% of your GDP annually to the NATO budget, was what you should be doing. And he called Germany out specifically as one of the culprits. Everybody lambasted him. But what's happening right now, what Donald Trump said then, is being implemented by others right now. The other thing that she was also saying is that this invasion had shattered the security architecture of Europe, and that Europe needed to rethink their economic dependence on Russian oil, gas, and coal. What does this mean? That you need to think about yourselves, you need to think about national interest. Oh, that's very interesting. Is that not what Donald Trump was saying when he was president? But at that stage, he was called a nationalist, and he was called an anti-globalization person. So what's very interesting at the moment is if you look at European politics, it does seem as though what's happening now is what Donald Trump wanted to do close to 3 years ago. But we will leave that interesting discussion for a little bit later. But in my view, what's happening right now is all of what's happening in Europe is strengthening Donald Trump's hand for 2024. But more about that, I think, in future talks. But what did we also see with this invasion? We saw significant disruption in the Brent crude oil market. This is European Brent crude. From December, it was up at its peak 73%. It's now sitting at 47. It fell a little bit lower, but you can see the extent to which it jumped when Russia invaded the Ukraine. And the main reason is that Europe is so critically dependent on Russian oil and also on Russian gas. But at the end of the day, what this has done has put huge pressure on commodity prices, specifically oil and gas. If we look at the gas side, just brought this in as well, since the beginning of the year, gas prices are up some 60%. Now, oil prices sitting up around about 50% from where they were, gas prices up 60%, inflation already sitting, as you will see just now, significantly higher than 7% in the US. This is starting to provide major problems. We're seeing a knock-on effect at our own gas prices, petrol prices as we call them here. We'll see that first week of April, but there has been significant pressure on oil and gas prices, and it's being felt across the globe. And this is a time when US consumer inflation is now sitting at close to 7.9%. The reading for the end of February was at 7.9. We can go back, I've gone back here 37 years. So it's pretty much the highest in 4 decades if you look at the US. So this is what we are seeing right now. We are seeing surging inflation, surging energy prices, and the US Fed has to do something, and it has to do something significant. What we're also seeing right now is that with the market expecting the Fed to react quickly and to react decisively, US Treasury bond yields have spiked even further. We saw earlier on that they'd got to around 2%. They peaked at around 2.5%, and now they bob around 2.5% and 2.4%. But what that means is any holders of G7 government bonds, specifically US 10-year treasuries, would have taken a pounding in their investment portfolios. Fortunately, we haven't been in that camp for at least the last 14 months. But what are we seeing again right now? We are seeing that markets are expecting 250 basis points of policy hikes in the next 12 months in the USA. That's up from the 104 that we were seeing early in January. And this is after the 25% basis points hike on the 16th of March. So the market is expecting significant interest rate hikes in the US this year, and potentially a number of them not being 25 basis points, but being 50 basis points. And that's putting a lot of pressure on the US bond market. So what has happened since Russia invaded the Ukraine? Here again, we've got the S&P 500 index, but I've rolled it from the 23rd of February to, in fact, where the market closed last night. What one can see, 23rd of February there was a bit of a bounce. It fell all the way back, but there's been a very, very strong run in the US equity market in the last 10 days. And what you have right now is what we do know is, having seen Russia invade the Ukraine, what we now know is that US equity markets have turned their back on the war. This is potentially when the war started, and that's where the equity markets are right now. So at one stage being down just before the war at roughly 12%, it's now down only 3.5%. And so the bottom line is equity markets have turned their backs on the war. What we believe is the valuation guidance that we got that showed us at the end of January that the market was getting pretty close to fair value and that we should start seeing some support. That's definitely been the case, and we are now nicely up in the US again. But the bottom line is that markets focus on valuations. The war may be a humanitarian crisis. They may be talking about nuclear intervention or not. That's a long story. I don't believe it's the case. But what's most important is if you look at European stock markets, this is the European index of the top 600 shares. They are at the forefront between the war between Russia and Ukraine. That market as well has moved up very, very sharply. And so leaving all ethics aside and focusing on economic self-interest, markets in Europe and markets in the US have completely ignored the war over the last 10 days to 2 weeks. And so what have we done? We updated 2 days ago. We updated our mechanistic valuations again. And what it's telling us is that the US is at fair value. This is where it was 2 days ago. But what it's also telling you is there is opportunity all over the show. The US is at fair value. Equities outside of the USA are cheap to the extent of 34%. UK equities are unbelievably cheap. European equities are very, very cheap. Emerging markets are 20% cheap. China is also 16% cheap. Global infrastructure is 16%, and our market is incredibly cheap. And so as we sit here right now, and we look at what we're seeing right now, we are seeing good entry points. We are seeing appealing valuations in global equities. G7 government bonds are not appealing at all, even at a yield of 2.5%. If we look internally, where yields can be anything between 9.5% and 11%, depending on the day, it is very, very clear that there is significant investment opportunity out there. South African equity markets are cheap. South African listed property is cheap, and South African bonds offer very, very good yields. On the offshore side, global equities are looking cheap. So what we see going forward from where we sit right now is we still see opportunity for decent gains in offshore equity markets and decent gains, either capital and or from interest payments on the onshore portion of our portfolio. So looking forward, war aside, coronavirus aside, China aside, by the way, we don't invest in China or Russia, our outlook going forward is one that is pretty positive. Something else that we've seen this time around is how resilient the rand is. And this is a chart of rand dollar. It peaked at about 16 rand 30 was what it cost you to buy a dollar. This chart was produced yesterday, so it's horribly out of date. Just before I came in, I saw the rand at 14.47. So not only has our equity market been resilient this year, but the rand has been very, very strong. I think, while that says good things about our currency market and our equity market and also our bond market, it's not so good for portfolios because offshore assets haven't been doing well. And so in rand terms, they've been doing quite poorly. And so one will see over the last 3 months that portfolios locally in terms of nominal returns are all taking strain. But we've had a very, very strong rand. And what's interesting about that is at the same time, you've seen a very strong US dollar. Normally when you see a strong US dollar, you expect to see a weaker rand. But now you're seeing strong dollar and you're seeing strong rand at the same time. And what that means is that the rand has this year, in fact, since the end of November last year, decoupled itself from the US dollar. And why has that happened? We just have to look at Bloomberg's commodity index, and you can see the surge in commodity prices. And this is a very broad range of commodities. And in fact, it is up this year by 34% alone. In fact, from the end of November to where it is right now is close to 40%. And interestingly enough, end of November was when we saw peak rand weakness at 16.30. We're now seeing it 14.47. So this is purely a commodity play that we're seeing. We are net commodity exporter, just like a country such as Brazil. Brazil's currency is also very much on a tear. So at this particular point in time, where we are also seeing value is that global equity markets are cheap, in many cases, fair value in the case of the USA. And with the rand at 14.47, you can actually buy dollars quite cheaply. So this to us presents potentially a very appealing entry point into further offshore assets. And I'm going to come to that a little bit. No, I'm going to come to that right now. So as some of you are aware, we run quantitative currency models. In fact, we call it a currency decoder. And we take a look at Rand dollar, and we are able on a daily basis to get an estimate of where fair value should be. And then we can produce a chart of how far away or how close you are to fair value. And that is this particular chart. The red line, when it goes north, it says the Rand is weak. So for example, here, late November, this bar was quite high, close to 5%. That was the Rand at 16.30, and the model saying fair value was a lot lower than that. The model got it right, because as we came towards the end of January, it went back to fair value. But now the Rand is incredibly strong. And we're sitting close to 9% cheap relative to fair value. So what that means is we can buy dollars now roughly 9% cheaper than they should be. And then what we do is we can take that red line and we can decompose it into two components, one which is blue, and that's emerging markets in aggregate, how they are reacting to the dollar. And what's very interesting is emerging markets currencies are currently strengthening against the dollar. But if one looks at purely South Africa effect or Rand dollar effect, that's the green lines, these things have just been phenomenally positive. So at the moment, there is very, very strong support for Rand dollar. And in fact, if you look at these kind of levels, we last saw those levels 20 years ago, when emerging market currencies were recovering from the emerging market financial crisis of the early 2000s. So the Rand is indeed very, very strong. And in fact, where I was sitting early this morning, caught the Rand at 14.51. We've got fair value at 15.86. So close to 9% is the extent to which you can buy dollars cheaply now. So although the very strong Rand in the short term has been hurting the onshore portfolios, it does present a significant opportunity right now when viewed in conjunction with the value offered in global equity markets. And I'm going to end on that, but what I want to do is I just want to very briefly take you through some of the numbers on the suite of Fussell portfolios. When you look at the 3-month numbers, you will see that there is some pressure not only in the funds itself, but peer groups. This is to the end of February. March, as you will see, we'll see some improvement. But if you look over the last 12 months and you look over the last 3 years, the last 3 years incorporate this going into year 3 of significant disruptions in many markets globally and potentially permanent effects in the Chinese market. You will see in all cases here that when you compare the return on the fund to its actual real return benchmark or target, you will see that the Fussell portfolios have managed to deliver returns that are in excess of the targets that we've actually set for ourselves. And some of these targets are quite challenging when we look at South African consumer price inflation plus 6%. You'll be able to take a look at these at your leisure. Obviously, you do get statements on a regular basis in terms of what has happened. But the 3 years to the end of February 2022, I would not hazard. I will support what Andrew says. We believe that the Fussell portfolios have delivered significantly pleasing results, not only relative to their own internal targets, but also to the peer group out there. And then this time around, I haven't shown you where we are positioned on an asset allocation side, because this is probably going to change in the next few weeks or months. And one of the reasons is we've been given new offshore limits in South African funds. And for example, where you were limited to some 30% in total offshore, including some exposure to Africa, which was very, very seldom used. We are now able to take in domestic multi-asset funds, 45% offshore. And the big question is, well, do you do this? And if so, how much? When we are looking at the extent to which equity valuations overseas are appealing, that is right now. When you can buy those appealing assets, potentially at a 9% discount, because the rand is so strong, now is an opportune time. But what we've also done is our mechanistic guidelines, and I must stress that our mechanistic guidelines that drive the way we construct and we manage the portfolios, these are here to eliminate any form of emotion in the investment decision making. Yes, there will always be some emotion, but we are always guided by what the mechanistic guidelines tell us. So what we've been able to do in the last 10 days is we've been able to extend our quantitative models. We've been able to extend them into a space where we can ask the question, if we were given unconstrained limits, how much, based on current valuations for each risk profile, should we send overseas? And this is now the offshore allocation guide that we have. So for example, a cautious portfolio 42, moderate portfolio 44, growth portfolio 45, and if you look at a high growth or even look at an equity portfolio, about 47%. So what our quantitative valuation based technology is telling us is that if you would like, you can take up that full 45% limit. These are discussions that we're having internally right now within our investment committee meetings, but global equity markets and the strength of the rand have given us a very, very good opportunity to move assets north of the 30% to which we have been limited, say, in the last 10 years. So I think I've managed to squeeze enough into what is an incredibly short period of time. I hope I've been able to paint a picture of the 4 catalysts that have driven what's happened in markets in the last 2 years. The funds have done particularly well. I've given you insight into some of the tools and the research that we use. You will see, as I harp on every time we get together, our process is very quantitative. We try to eliminate emotion. And what this has done with the Russian invasion of the Ukraine, it's allowed us to eliminate all emotion from the process of positioning funds. However, the discussions around what's happening in the Ukraine are quite extensive. I thank you for your time, and I hope that we've been able to give you a bit of comfort that we take the investments in these portfolios seriously, and that we're able to guide you through disruptions, either temporary or permanent. And in closing, if you have any questions, please direct them to Andrew by email. I will be more than happy to deal with them. And thank you for the challenge, Andrew, and thank you for the opportunity to present. Back to you, Andrew.
Thank you very much, Lance. I have no idea how you squeezed that in. Massive amount of information to be shared. So a huge thank you from all of us. I think you covered it magnificently. I don't know. Again, I don't know how you did that. Just for everyone's benefit, Lance did mention that the Reg 28 has opened up a bit. That's the offshore allocation. So what we decided 2 weeks ago in the committee meeting we increased the portfolios by 5% offshore now, and it's constantly under review. It's constantly under discussion. We don't want to wait for the rand to blow out to 60 and then pull the trigger again. It's a very, very tricky exercise and something that we are watching very closely. So the March fund fact sheets will be different to the February ones, as Lance alluded to, because of that. So, it's a very exciting time for us all. Lance, you mentioned Trump. Now, you were the only person that called Donald Trump winning the election a few years ago. Your view on the next one?
Andrew, the one thing that I actually didn't bring today for obvious reasons was my Trump 2024 T-shirt that a friend of mine brought from the USA. And that's interesting. You can already buy T-shirts and caps. The cap says, "Make America Better Again." And then it says Trump 2024. Those are now widely available in the US. And there is a big concern amongst many people that what's happened with inflation and what's happened with the Russian invasion of the UK has played directly into Donald Trump's hands. It has the virus has shown that global supply chains are quite wonky. The dependence in Europe and the UK on Russian oil and gas has been a big problem. In fact, so much so that I heard the other day that the European Union spends 217 million euros a day buying Russian oil and gas.
Wow.
Yeah. But I honestly think this may well be playing into Donald Trump's hands. And I think he's going to be, he or whoever represents the Republican Party will go back 3 years and say, "We warned you. We told you this was coming." And I think these midterm elections in November are going to be very, very difficult for sleepy Joe Biden.
Thank you. Last thing, I know it's a terrible question to ever ask anyone, but obviously the rand strength has continued because of the commodity spike, as you said.
Yeah.
Do you think that is sustainable?
You know, I said we go back 20 years to see this amount of positive attitude towards or sentiment towards rand dollar. The initial response there was currencies recovering from the emerging market financial crisis. But then we moved into what was going to be a commodity super cycle, 2003 to 2006. And the rand remained resilient for quite a while. So there is a threat that this rand could remain strong for quite a while. But you can already see with the dollar that the minute it looks as though there may be some form of truce agreement, be it in the next few weeks or the next few months between Russia, let's call it Russia and NATO, the dollar starts getting weaker very, very quickly. The problem is that leads to stronger rand. So my personal view is that I don't think that these commodity prices are sustainable. Very definitely not under the current inflationary environment you're seeing in the US, the UK, and Europe. I don't expect the commodity prices to return to levels that we saw end of November last year, but I do see a certain element of easing of these prices. You're actually seeing it already, particularly in Brent crude. So my concern is that this opportunity to buy dollars cheaply might not be around for a long period of time. You may in a few months be able to still buy dollars cheaply, but definitely not to the extent of 9%. So I do see some easing in commodity prices, and I do believe that the big risks to the rand from here is that it moves back to fair value, which is at 1586.
Okay. Thank you. Well answered. I'm sorry to have to throw that question at you. It's a dreadful question to have to ask. But again, a huge thank you from all of us. I do send it out, and I get a massive feedback from people once I've sent the video out. I think it's just a lot easier for people to watch it in their own time. So again, we look forward to hearing from you in September again. But thank you from all of us. We really appreciate what you do for us. Thank you.
Thanks, Andrew.
Goodbye, everybody. Thank you so much for joining. We hope you found it interesting.